That looks good. Can see it.
Okay, thanks everyone for attending. If you don't know me, my name is Sachin Maharaj. You can see my background there quicker than I can read it out to you, but very quickly, I have spent about 33 years of my working career in banking. Most of that has been in financial markets and as CFO roles, and I've done a lot of senior roles across HSBC, and formerly was general manager of wholesale banking at St. George as well. During my 33 years, I had a lot of interaction with the Reserve Bank and APRA. I was primary contact for APRA at every place that I worked. So I have good insights in terms of how the regulators actually work, how the Reserve Bank board thinks. And I was on a lot of industry committees as well, where we talked about the economy and the markets. And last but not least, the property markets, which has been my key area of focus for the last 4 years since I've left banking. And what I enjoy doing now is actually providing insights into the property market and giving you my frank view of where I think the market is heading. Now, one of the things we in Nivas, which is our real estate company, one of the things we do is we would only showcase to you and tell you about where you should invest. And we do that very carefully and selectively. So right now we are not promoting house and land in Sydney. We are not promoting land in Sydney. We don't think that that is the right investment for you right now. Last year, that was different. The year before, that was different. So what I'm saying to you is that not necessarily are those type of investments bad investments. All I'm saying is we only present to you where we think you're going to get the biggest bang for your buck if you invest now. So in Sydney, we are promoting apartments, but we also look at what else is available right now and today for you to invest in that will give you the biggest bang for your buck. So that is what I will be talking about today. But first and foremost, a bit of history. You know where we have come from in terms of the property market in the last 12 months. And the big winner here at the moment is you can see Brisbane and Adelaide. And today we are going to showcase Adelaide. And some of the regional areas also, the combined regional areas are also quite strong. But as we go through the changes that you are seeing in the market right now, and all of you listening today, I have got your own insights, your own perceptions about property. What we're all seeing is that you have to be a lot more selective in where you invest, whether it's region, whether it is Sydney, whether it is interstate. Okay, I won't dwell on that. In the last few days, some of this news is actually today's, and weeks, what we are seeing is all these headlines. These are the headlines that impact properties, okay? Reserve Bank interest rates. You've all heard that 50 basis point increase to 0.85. I'll just tell you that 0.85 is still historically low rates, okay? Yes, it is going up further. Absolutely, it will go up further. How quickly, we will talk about in a minute. US Fed, that's their RBA, increased rates by 75 basis points last night. They have a range system, so their range is 1.5 to 1.75. That is where the interest rates have gone in the US. They're sort of accelerating it. Their inflationary worries are a lot bigger. There is also a lot of talk about the potential for recession fears in the US, which has caused the stock market. If you've been watching the stock market, if you own stocks locally or in the US, it has gone down significantly in the last week and a bit, particularly in the last 4 days, okay? That has had even a bigger impact on our markets here, where the markets has wiped out billions of dollars of people's assets. So these three on the left are negatives for property market, okay? They're definitely negatives. On the right side here are some of the news that are positives. Paratat has said they wants to scrap stamp duty. Australia is facing the national rental crisis as vacancy rates keep falling. We'll talk more about the crisis and the fall in vacancy rates. Okay, the rental prices are going through the roof. Labor force figures came out today. Okay, and we're same as last month pretty much, except the number of jobs advertised out there, which is over 60,000 jobs, new jobs being created. That is a big figure. So this figure you will actually go lower in the coming months. It will head lower. It won't surprise me if before the end of this year we are at 3.5. And that would be a record low. We're already at 48-year lows. So unemployment is doing extremely well. You all heard a couple of days ago, minimum wages has been gone up by 5.2%. Whoops, sorry. And Australian wages is growing, but not as fast as inflation. We all know that as well, okay? If any of you had a 5% salary increase recently, then you're doing very well. And Australia's economy rose 0.8% in the March quarter. This figure came out recently as well within the last week. Now, the good thing is these economic indicators are strong indicators of what is happening when your unemployment, and these two figures are very important. When your unemployment is low and there is more jobs than you can fill at the moment, then it is a good place to be as an economy. Because jobs means security, means your confidence is up, means you can spend money. But on the counter side, they are wanting you to spend less money so that there is less demand for goods, so that inflation goes down. So that's this left part. So they got to find the right balance between economic growth, unemployment, and inflation. And that's a 2-hour talk on its own. So I won't try to cover all of that, but we will touch on it and we can take some questions on it, okay? But this last one is very important. You want your economy to grow so that you don't go into a recession, okay? So what has happened, what is causing this inflation is a number of things, and we'll go through that shortly. But firstly, my top 7 points that actually moves the needle on property prices are these 7, and they are in some sort of an order. First and foremost, supply versus demand. Any commodity out there, this is economics 101, any commodity, whether it is cars, and you've seen that with COVID and the car prices went up, secondhand car prices went up because there was no supply and there was huge demand. Same thing happened with house prices, okay, in 2021. And you saw how much house prices actually went up because the demand increased primarily due to interest rates going down and affordability increasing to a level that we have never seen in our history. So with this, demand went up and supply was low. It caught supply by surprise. So you can't go and develop new apartments or new houses or develop new land all within a year. It takes a 3-year term to actually do that. When demand goes up so much and you've got a lower supply, guess what happens? Prices go up. And that is one of the key reasons why prices went up as much as it did. Then the third one is the regulator, and they've got a number of levers to pull. Okay, APRA is our regulator for banks, and they dictate bank lending policy, and they can actually come out and stipulate a number of things with banks. And my 20 plus years of dealing with APRA, I can tell you that they are one of the most prudent regulators of banks in the whole world. Is that a good thing or a bad thing? It is absolutely a good thing. Okay, absolutely a good thing for our economy, for our well-being. And if you don't have the type of if we didn't have the type of regulation that APRA has, that we had in the global financial crisis, we would have seen significant losses by banks in Australia. We did not see that. And again, that's a topic for another day, but we have a very prudent, and we've got recognized as the best regulator in the world because of that, okay? GDP and unemployment, I just touched on. We made sure that through COVID, the government ensured that they had plenty of government spending, infrastructure approvals, incentives, JobKeeper, JobSeeker, all of those things to make sure that number 4 stays in check. and it did, and the government did an excellent job actually. Okay, yes, we've blown our deficit. Everybody talks about the $1 trillion deficit. It was $500 billion when this government actually took over the deficit. Nobody talks about that. That was created by the Labour government. But during the last 10, 11 years, it has doubled. Okay. Main reason why it's doubled is because we had to do number 5 to make sure we have the bounce back that we are seeing right now. Our strong numbers with GDP and unemployment. Anyway, won't give a political speech. We'll move on. The 6th one is very important. Everyone is talking about corrections in house prices by 20%, 25%. There were same economists of banks and other companies, AMP and so on. The same economists were talking about a 20% to 25% decline in middle of 2020, when we were right in the thick of COVID. And it didn't happen. It did not happen, okay? One of the reasons why it didn't happen is because we did not have loan delinquencies. Banks gotta have delinquencies and loan write-offs for prices to fall that much. So I've sat on a lot of risk committees in banks, and I can tell you that people pay their mortgages in Australia. They might not pay their housing loans. Sorry, they might not pay their personal loans. They might not pay their car loans. They might not pay their credit cards, but they do pay their housing loans. They save what is the roof over their head, okay? When you have 1 month not paid, 2 months loan not paid, 3 months loan not paid, then the bank gives you letters that start to worry you, okay? And the bank actually calls it their worry list. And when the worry list happens, the 4th month, the bank will start talking about doing a mortgage in possession sale. They'll take your house and they will sell it in the market in an auction to recover their loan. I don't know how many of you have seen a mortgage in possession sale. In the last 20 years, there have been very few and far between, and we haven't seen them. The reason why we are not seeing those is because APRA's regulation on the lending policy, they use a 3% buffer on the interest rates, on the variable interest rates when they assess your mortgage. Okay, that is one of the most prudent in the world. And that's why it's a good reason why they do that. So if interest rates go up by 3%, the banks know that you will survive because their assessment of your ability to pay is already quite conservatively done. So we are not going to see, in my personal view, we are not going to see high levels of delinquencies. You need very high levels of delinquencies and no buyers of properties to actually see a 20% decline in property values. Please understand that and bookmark that when I talk on some of the other slides, because when people say 20%, they don't know what they're talking about. Most we have had in terms of price drops in our city here in Sydney, take Sydney for example, is 5, maximum 6% in the last 50 years. Okay, we have not seen bigger price drops than that. And we have got so many other things coming up in terms of demand. Global factors, very important. I won't dwell on it, but COVID-19 has caused supply chain issues. The war has caused supply chain issues. Both these issues have caused spike in inflation. Some of the inflation is local, caused by floods and hurricanes and other things, but the majority of it has actually come from overseas, okay? Petrol prices, for example. All these other things can have an impact on us. Equity markets, as I said, is falling at the moment. People feel that in their hip pocket. They feel a little bit poorer, and that changes their psyche in terms of how they spend, how they buy the new cars or buy another investment property or buy a few more TVs and so on. So all of these factors have knock-on effects on the price of property. Okay, they are my top 7. There are other things as well, but we will go through interest rates now. So interest rates, inflation went to 5.1 very, very quickly. We thought the Reserve Bank wants it to be between 2 and 3, ideally around 2.5. The US Fed also wants it to be around 2.5. Now, how aggressive are we going to be to actually bring it back to the normal inflation rate? That aggression will depend on these things here. The pace of growth will be how quickly the supply chain issues will be resolved, how quickly will wages grow, and other global factors. These things together will determine the pace of the growth of interest rates. At the moment, the governor yesterday of the Reserve Bank clearly said that we expect inflation to actually peak close to 7%. So that will happen sometime between now and end of the year. You cannot actually save that, okay? We have some local factors that are impacting inflation. So apart from the petrol prices and the cost of food, your primary food items, you've got things like rent, which also make up part of our CPI, our inflation, okay, a consumer price index. So rents are actually going up. And you'll see some of the graphs I'll show you shortly. With rents going up as much as I think could be 20%, that forms a decent part of our inflation numbers, somewhere between 5 and 6% of our inflation number. So that all these things together have an impact on inflation. So it's not something that you can control in 1 or 2 or 3 months. It's going to go up. But the Reserve Bank governor is quite confident that from the first quarter of next year, things will start to stabilize and inflation will start coming down. So time will tell, okay? Reserve Bank governor also told us that there'll be no interest rate increases until 2024. So you can't always believe what the Reserve Bank governor says, okay? But one thing is for certain in my mind is he is not going to be aggressive because we have to make sure our economy keeps growing. If you spike interest rates quickly, you risk the fact that inflation might come under control. But if you hurt people badly, then you're going to find that the growth numbers are going to start to suffer. And that's the balancing exercise that I think the Reserve Bank has to do. Now, if you look at the graph here, we've come from here, and I remember this period because we did have a recession at the time, and that was our last recession. Actually, before that actually was our last recession, but late 80s. But I do remember that paying 17.5% for my first mortgage in Sydney. I have been here a long time. And now when you look at the graph and we're here, and we're thinking about slowly creeping up this way, okay? We're thinking of a 2.5%, still half of, we are still in a very low interest rate environment. So please, everyone, so those of you that haven't been in Australia for more than 5 years, one of the things to keep in mind is we still are in a very low interest rate environment, okay? So all of this hype that you hear in the media, it's what people want to hear. It is scaremongering at its best. So what the Reserve Bank is doing is bringing the interest rate back to where we were pre-COVID by 2019. So most of you who've had a mortgage in 2019 were paying between 4 and 4.5%, maybe slightly higher than that. I was. And what we're doing is we had to have a reduction down to close to 2% in some cases. And that was what I call the last 2 years as a honeymoon period caused by COVID. That honeymoon period is over now, and we're going to go back to the rates we had in 2019. Is that going to mean everybody starts selling their houses? Absolutely not. But that's what the media is trying to tell you. Do not listen to the media. Okay, if you want to invest in property, the last thing you want to do is listen to the media blindly. So just very quickly, from 2002 to 2008, prices were up more than 30% despite cash rate increasing 3 percentage points. That's 300 basis points. Okay, now this is reasonable comparison with the current period. Interest rates are increasing, may increase quickly, and we have a period of strong wages growth, which we expect to see this time. With unemployment going to 3.5, we are going to see wages growth. Okay, definitely it will happen. From 2009 to 11, home prices were also up 11%. and we're up 6.6% at the end of the tightening phase that pushed up rates by 1.75. So in this period, rates also went up 1.75 and property prices also went up. One of the things you've got to remember is when interest rates actually, when inflation happens, inflation causes price of goods to actually go up. When price of goods go up, the cost of construction of properties goes up and property prices also go up as a result, okay? Media will not tell you that, but I'm telling you that history tells us when there's a high inflation, you look at the correlation between high inflation and property prices, they move together. Now let's get more centric to Adelaide, which is what I want to focus on today. So very quickly, you can again read those bullet points faster than I can say. Property prices are up. The median price in Adelaide is still quite low compared to the rest of Australia. It's the third lowest in Australia after Darwin and Western Australia. Gross rental returns are still reasonably high. In some places, you'll even get higher than that. And rental prices have risen 8% in the last year. Sorry, this statistics is actually a bit old, but that figure is going to go up significantly. And that's because of the vacancy rate, which is at 0.3. I've got a few slides here in terms of why you should invest in Adelaide. So those of you that don't know Adelaide or may not have been there, hopefully these next few slides will give you some insights into what Adelaide is all about. Adelaide has recently been named the third most livable city in the world, which means it's also most livable city in Australia. Auckland was first and Osaka second. This study looks at all these things, okay? Stability, healthcare, education, culture, environment, innovation, infrastructure. They give you scores for all of these factors before they actually work that out. That's quite a big deal for Adelaide. So we have seen the highest levels of interstate migration to Adelaide happening in the last 12 months. That's the lowest in the last, highest in the last 30 years. Now, in those things that I just talked about, so infrastructure, firstly, infrastructure. So you've got education. Some of the highest ranked universities are in Adelaide now. They've got a reputation as a university city now, comparable to both Boston to that of Boston in the US. Health. South Australia has become an epicenter for health, ever expanding health precinct in the heart of the CBD. Researchers are helping to develop world-leading research with global implications. And we saw that partly through COVID, okay? Defense, it's become the country's defense state. And you've all heard about a number of things, and we've got more slides to show you in a minute. Environment, the city is, a very livable city. It's got beaches. It's got a lot of outdoor adventures, wineries, and all those type of things. So a few infrastructure projects that I want to highlight. CBD is getting transformed. Redeveloped Riverbank Precinct, which is happening, this slide here. You got Central Market redevelopment, this slide here. So millions of dollars are being spent. Then one of their biggest projects has been the Torrens to Darling Highway project. This highway goes from the north of Adelaide, and this is where some of our projects are that we're going to show you, all the way going down, and this is where the port is and the submarine project and so on, all the way down to Adelaide CBD, which is here, and then that goes all the way down. Now this section here hasn't been connected yet. So this section here is called the Torrens to Darling Highway project, $9 billion project. It's going to inject $4.8 billion into the South Australian economy. Lots of things happening in that state, okay, and in that city. Innovation, you've got companies like Google, Amazon, MIT coming in, Deloitte, PwC. There's multinational companies like Accenture coming in. Australian Space Agency have opened the doors to new offices. All of this is part of the innovation space, okay? Lot 14, which is what you're seeing over here on the right, creating a precinct that is making a global impact by accelerating innovation and so on. And Tonsley Innovation District, which is this slide here, partnering with leading edge research and educational institutions. There's a lot of things happening in this city. Now, I'll show you a few other quick slides, conscious of time. So we all know about the naval shipyard there. and how much extra we had to pay, and then get rid of the French and create issues with them with the last submarine project. But now we've got the new submarine project, which is going to create plenty of jobs as well. We've got the airport expansion happening in Adelaide, and the multi-billion-dollar submarine project. Now, the other thing I want to, for those of you that don't know Adelaide very well, when we talk about mining in Australia, most people just think about Western Australia. Western Australia is not the only mining state in Australia. South Australia holds its own when it comes to mining, okay? Some of the major projects in mining are, you can read this here. So the Olympic Dam expansion is massive. Woomera open to mining, $1 trillion. Okay, these are massive numbers. These are all massive numbers. And I want to talk a little bit about the Olympic Dam. If you've not heard about Olympic Dam and its importance to Australia, well, I can tell you that Olympic Dam is the biggest deposit of uranium in the world. So if I look at the graph on the right here, and you see which mines in the world have the biggest uranium resource, Olympic Dam is up here, okay? The rest come down here. So the rest just keeps going down. This is the rest of them, okay? The world's top 20. Olympic Dam by far is the biggest in the world. So if you're talking about uranium, this is the country that has the biggest deposits, okay? Once completed, it will be the world's largest open cut mine. This is important because mining has actually kept the Western Australian economy strong. You need more than one thing to keep the economy strong. And all I'm trying to illustrate here is that Adelaide has significant mining projects to keep it going for a very long time, okay? Now, world's largest source of uranium, its biggest gold resource in Australia, also there, 5th biggest gold resource in the world, 4th biggest copper resource in the world, has a commercial life of over 200 years. This is important to know because these are the type of factors that keep the economy strong. A few other quick ones, which is most of this you'll find is very, very recent, okay? So what I've done is I'm not giving you history. There's a 1.9 billion women's and children's hospital that is being built. You have got this new one here, which is, you can see the date there, okay? Just a few weeks ago. 1.25 billion developer Gurner is moving into Adelaide with a partnership with Canard Self-Storage. These are all big projects. Monday, 13th of June, office heavy hitters raise stakes in Adelaide CBD. Then the bottom one here is, again, it came in the news a couple of weeks ago, the Barossa Valley. You've probably all heard about the Hunter Valley, but Barossa Valley is bigger than the Hunter Valley. Probably the best wines in Australia come out of the Barossa, and a lot of people go to Barossa just to go and have a weekend and wine tasting. Well, it is approved now, and it will be ready in 2024, a $50 million new 6-star 12-story hotel in the middle of a vineyard, okay? It looks like something out of space, and people will travel all over to go and see this. Now, this Barossa hotel is only about 20 minutes drive, 20 to 25 minutes drive from North Adelaide, where some of our projects we're going to show today. The other thing, if I haven't told you enough already about Adelaide and what is happening there, well, on 5th of June, they broke some records. So this house in Adelaide, in 16 Bellington Street in Walkerville, actually sold for $3.6 million, which was almost $1 million over its reserve. This is a hot market. You would have never have dreamt that this would happen in Adelaide. I'm not suggesting that this is going to continue. What I'm illustrating here is when you've got a property in Adelaide which sells for this much over reserve, that filters right through the market, okay? The demand is very, very high there at the moment. That's all I'm illustrating. So the Adelaide property market. Why is it a great buying opportunity? Well, here are my main reasons. we still are at historically low rates, and the banks have a high appetite to lend. The big four banks in Australia, half of their balance sheet, so if the balance sheet is $800 billion, 400 billion of that, half of it, is actually residential mortgages. That's their bread and butter. That's where they make their money. That's where they have a 2% margin and make money, okay? So there's a high appetite will continue for banks to lend in that space. Demand will continue to be strong. We all heard about migration and why there's the backlog of migration through COVID. We've got a lot of returning expatriates and students, and people want to go and stay in a place where they have a more relaxed lifestyle and where is job opportunities, and Adelaide actually provides that. And students we've already talked about, and students, Adelaide is one of the university cities in Australia. There are still positively geared properties in Adelaide, okay? So investors are attracted there more so than ever before. And there's a lot of places where it's still cheaper to buy than rent. And supply is significantly down. We are now finding in Adelaide what we used to find in Brisbane about 12 to 18 months ago. So in Brisbane, the market was absolutely crazy, and they've had a massive increase in the house and land prices. Same happened in Sydney. And if a land, we used to send our clients land and house and land packages, and we used to tell them that you've got 24 to 48 hours, otherwise it'll be sold. And that is exactly what happened, and a lot of people kept missing out until they actually bought something. This is now happening in Adelaide. So if you don't secure something within 24, 36 hours, it's gone. So there's still supply chain issues, and there are fewer more properties on the market compared to demand. Number 4, cost of construction is already up, and guess what? It's going to go higher. It has to go higher. Okay, I know prices are going higher. Cost of timber is going higher. All the supply chain issues are causing all raw materials to go higher. So if you lock in a price now, if nothing else happens, because of construction costs, your house value will be more. Rentals, I said I'll talk about rentals, is heading up and up. There's a chronic shortage of properties to rent, and Adelaide happens to be the lowest in terms of vacancies in Australia. Then there's the FOMO effect. People haven't bought, they want to buy. Fear of missing out. And that still is there despite interest rates going up, okay? Because people are cashed up and they're looking for a good investment. Like I said, you've got to find the good investments. It's not the same as a year and a half ago. You have to actually look, and that's where we come in. Consumer confidence, business confidence still remains high, and you will probably find in some sectors this may suffer as interest rates start going up. And where there is wages growth, it will be harder for businesses, some of the businesses, to make money. But right now, I can tell you both these factors remain high. There's been a high level of savings during COVID, and that is one of the reasons we have been spending more money, buying new cars, buying new TVs, investing more, and renovating our houses and doing all of the things that people do when they're cashed up. And that is part of the reason also why inflation has gone up. And that's what the government wants to pack back a bit, okay, without affecting growth. And the last one I've talked about. Okay, so Adelaide's, this is 1 month old, but it is the same numbers, I can assure you, in May. So Adelaide does stand out. Nationally, we are at, I think now we're at 1.1 in May. So slight increase, but you can see where we were in April 21 and where we are now. Okay, Adelaide was always a tight market, and it's become tighter. At 0.3, it is impossible to actually go rent a place. We're finding in Sydney right now at 1.4, it is starting to become impossible to find a rental property. If you're trying to look for a house, impossible. If you're trying to rent an apartment, it is possible, but you have to be quick. And soon this figure also is going to go down. Not maybe to Adelaide levels, but certainly to Brisbane levels, okay? I think by the end of the year, you'll see that. This is a chronic shortage of properties, and rents are gonna go up and prices are gonna go up. So if I took this out today for North Adelaide, okay, the North Adelaide area where vacancies were up here in 2016-17, you look at what's happening. There's a running out of land. So it has gone all the way down to about 0.2, okay? This is about 0.2, so it is even lower than where Adelaide's total is. This is North Adelaide. So keep that in mind when you're buying a property. Not only do you look at the vacancy rates now, but you've got to look at where vacancy rates are going to be in 1 year, 2 years, 3 years time. And this trend is not going to stop because of all of the things that are happening in the north part of Adelaide. So the story is very simple. Economic growth brings jobs growth. This is the simplest graph I'm going to show you today. That brings wages growth. Population growth we've talked about, okay? All of these factors are happening. That brings increased rental and buyer demand, and that brings increases in property values. Irrespective of where interest rates are, this phenomenon holds true, okay? Now, very quickly, again, conscious of time, when I first came to Australia 40 years ago, everyone said to me, it's all about location, location, location. 3 things. I'm sure real estate agents tell you that today as well. And I believe them. But what I also learned in the last 40 years is location. Yes, all of these factors here are very important, absolutely important. It's still my number 1. Number 2 is very important. You must never pay a premium for a property. So how do you know whether you're buying at the right price? You need to do your homework. You need to do your due diligence. You need to look at the trends, and you need to listen to experts like us who have done some of that research and who are actually proposing something to you which is at the lowest end of the market. I will never advise you to go and buy a 2-bedroom apartment in Rhodes for $1 million today. Absolutely not. Okay, that is not my job. I know you are going to curse me. So what I would do is I would select what I would buy myself based on my 40 years of experience and suggest that to my buyers. So price is absolutely key. Timing is key as well. So timing for certain properties right now, I would say no. But for other properties that we select and push to you, yes, absolutely. Okay, so you need to pick the price, the timing, and make sure you have a developer and builder that is credible. So all these factors are very important when you're buying a property. It's not just about location. So if you're still not convinced about Adelaide, this is my last slide on why you should buy there. The demand for property in Adelaide is hitting record high, okay? It is the highly affordable city, 3rd only lowest in Australia after Darwin and Perth. So if you look here, that is the median value in Adelaide still. Brisbane has moved up strongly in the last 18 months, very, very strongly in the last 18 months. The potential for this to go up to the Brisbane level, which is what I'm saying, Adelaide is today, this is what I'm saying, where Brisbane was 12 to 18 months ago. More upside is coming, okay? And you can see the stats and everybody, in every news bulletin, you will see every month for the next 6 months, Adelaide first and then Brisbane will be on that list, saying that they are the outlier when it comes to increases in property prices and rental vacancies. I will stop there and I will ask my colleague, Raj Nanda, to showcase our current project in Adelaide. Thanks, Raj.
Thank you, Sachin. Thank you, Sachin. Good evening, everybody. My name is Raj. I'm part of the Nivas sales team. So firstly, thank you so much for joining us tonight. I'm going to be talking about the area and show you some exceptionally valued packages that we are currently doing. And we'll also show a co-living package, which we'll get into that in a minute. So the packages that we're talking about is located in Manapara, Now, Manapara has all the essential amenities that you need. You've got the government, private schools, like government schools, private schools, shopping center. It already has got Coles, Woolies, Bunnings. There's multiple parks as well, sports and recreational areas. In terms of the health, it's only 10 minutes away. I mean, there's multiple hospitals, but the key one that I would like to talk about is the Lyle McQueen Hospital. That one is one of the largest ones in South Australia. So we're just 10 minutes away to Lyle McQueen Hospital. They are planning a further upgrade of $58 million, which is about to complete by end of this year. So money being spent in the health sector as well. In terms of transport, you're about 5 minutes to Smithfield train station, and that it goes directly to Adelaide CBD from there. Before talking about the location, I'll quickly just tell you something about Playford Council. So Playford Council currently has got a population of about 96,000. And it's expected to increase up to 136,000 by 2036. Now, that is a 40,000 rise in population number, which is huge. So just wanted to touch base on that there's a lot of demand coming in. There's a lot of immigration happening, a lot of students heading towards Adelaide, for ease of permanent residency as well. So, yeah, we can move to the location. So from the estate that we are selling, it's about 35 minutes drive to Adelaide CBD, which is really good. You're about 25 minutes to Port Adelaide, where the defense project is happening. So this is obviously towards CBD. On the other side, which you can't really see in the map, on the northern side further up, you're just 20 minutes away to Barossa Valley, which is obviously Sachin mentioned. It's one of the best wine producing areas in Australia. So, yep, we can move on to the next slide. So in terms of the packages, guys, this is the first one. It's priced at 500 and 1,700. Land size is 375. That's actually, that's an error there, sorry, but that's actually 375 meters square. Your build is 177. So it's a single story, 4-bed standard house, 4-bed, 2-bath, 2 garage. You have an additional living area as well. 2.7 meter ceiling heights. You've got reverse cycle, ducted air conditioning. You've got the stone benchtop, 20 landscaping fencing is included. This lot is registering by end of this year. And the rental estimate for this, you can see somewhere you'll be sitting somewhere about 480 per week, which obviously after the tax benefits, it's positive cash flow. If you move on to the next package. So this one is obviously a little bit on the cheaper end. It's again, 375 square meter is the land size. But it's a 3-bedroom, 2-bathroom, 2 garage, just to make it a bit more budget friendly. You're looking about 440 per week. Inclusions are obviously the same, guys, with all the packages. So your rental here is about 440. So again, so if you're spending about 450, 460, that's the sort of rental you're getting, 440, 450 per week. The build is 150 square meters for this one. And land is expected to register by March of 2023 next year, which gives you plenty of time. So you're going to have a lot of time before even it registers. You may be sitting on a gain the way the market is heading. Now, the third package that I'm going to talk about is the co-living. But before I show you the layout and everything, I'm just going to just give you a bit of an idea what co-living is all about. So basically with co-living, what they're doing is they've designed the house in such a way that you can have multiple tenants in there, right? And it's all legal. You can have a management agency looking after it. So this design has been done that way. So how we do this in a nutshell is you get 3 bedrooms. All 3 have got en-suites, full en-suites. You've got a larger kitchen space. There's more storage in the kitchen. There's more storage for linen cupboards as well. Every single layout has got lockable pantry. So 3 tenants, 3 separate lockable pantries. And each tenant will have, so that every tenant has got a dedicated storage space, right? Nobody steals from anyone. So we want to keep it all nice and safe. We've got extra linen storage as well, like I mentioned. Now we can head on to the plan. I'll just show the design. So if you look at the design, guys, a standard house like the previous layout was 422, 4-bed, 2-bath, 2 garage. This one is actually 4-bed, 3-bathroom, 3 en-suites, and a double garage. So like you can see, every single bedroom has got an ensuite. Now this setup, like I was mentioning, it'll give you a provision to have 3 separate tenants. Each tenant will have a separate lease, which allows you again to have a management company to look after it, regular inspections, make sure the property is good. So many times what tenants do, they share the fourth, like you see the 4th bedroom, which is the media room. So we do have a 4th bedroom, but we call that a media room. So one of the tenants can use that as their personal living space. Totally depends how you want to play around it. We're happy to discuss and give some advice on that as well. So another key advantage I wanted to tap into this, that at the time of selling this property, you can sell this as a 4-bed, 3 full bathroom, double garage, instead of a 3-bedroom. So that gives an additional value to the property, and it's easier to sell compared to a duplex, compared to a dual living. Dual livings, the banks, they don't really, the valuation sometimes doesn't stack up, but there are reasons behind it, because you've got 2 properties and then you've got a single title. But with this, it's very clean, simple, easy for bank to value as well. If anyone needs any further information, this is just in a nutshell, guys. If everyone needs any further information, we're happy to chat. Just, go back to the person who invited you or speak to any one of the team members. We're happy to talk a bit more about the co-living. This one obviously is priced at $529,890. It's a little bit expensive because we've got the extra space and the kitchen, larger kitchen and the extra bathroom as well. Again, 375 square meter block. It's registering in March 2023. Now, rental difference, you can clearly see here, is about 600 to 680. That's what we expect. So minimum, you're getting about 600. That's $200 per room. So huge opportunity for any investor looking for cash flow. Now, with if you move on to the next slide.
Can I just add one thing? Sorry, Raj.
Yeah, sure.
Just on your point about having to resell. You could sell it as a four-bedroom house. You've also got entrance through here to this bathroom. So this is a 2-way bathroom. So rather than be just an ensuite, it can be used as a common bathroom as well.
Correct.
And
yes.
These are 3 linen, separate collocable linen cupboards, which is, again, this is based on the preference of people who do co-living, and then 3 lockable pantries in the kitchen, which actually gives you the security and the privacy is what the focus has been in terms of building this house. And there's a very high demand for this type of properties, and is very well managed through the real estate agents that we use.
Yeah, correct, guys. So we've got already a big pool of renters looking for houses. Like there's already very tight vacancy there. So we've got renters, we're working with people on ground. So they have said these houses are very much in demand. In terms of the payment terms, so if you'd like any package, any one of these, we've got more packages available as well. Other areas too, which we can definitely look into, speak to you one-on-one. It's $1,000, which is fully refundable for about 3 days to secure. 10% deposit on land, and it's just 1.5% on the contract. Now, in terms of the deposit on land, guys, on a case-by-case basis, we may be able to negotiate better terms. And the developer is quite accommodating, but I would like to mention this, that if you do like something, if you are serious about it and you want to put in a deposit, we can have a chat to the developer, of course, and we can reduce the payment terms. We can try to do that 100%. Happy to do that for you guys. But we will expect an expression of interest and a deposit post that, because that's on the basis of, that's how the developers would like to operate. Obviously, it's really high in demand, that area. So,
I'll just add, Raj, again, sorry, these terms are highly favorable compared to what you pay in Sydney and Brisbane and other places. So you just pay 10% deposit on the land and only 1.5% on the house, which is very, very low, actually. I've never seen it this low in any other part of Australia.
Yeah, at an average, what we're sorry, Sachin. At an average, what we're looking at is you're looking somewhere about $26,000 for a home and land package if you go as per these payment terms. So it's not a large amount compared to what we do in Sydney. So yep. Okay, land registration, like I mentioned with every single package, some of them are registering by end of this year. We do have some packages that are registered and ready to build, again, depending on your requirements, but the ones that we've showcased, they are registering, some are registering end of this year, and then some are registering early next year as well. Build time for a single story house is approximately 6 months, depending again, if we don't get bombarded with rain. So we have to keep that in mind as well. But yeah, pretty standard timelines in terms of the construction as well. And that's where I'll stop, and I'll hand it back to Sachin. Thank you, guys.
Thanks, Raj. Okay, a couple of concluding comments, as I always do, is you must invest in property to generate wealth. I think it's most of you already know that, and some of you probably hold more than 1, 2, or 3 properties. The reason why I say that is a class of asset that will keep growing because the Australian cities keep growing and the property prices continue to go up. I don't have to tell you that if I offered you a property with a price tag 3 years ago, or 5 years ago, or 10 years ago, none of you will say no to that. It's a silly question. So the same way, in 5 years' time, if I said to you that if I offered you a price of 500,000 for a property in North Adelaide, you will be taking that as well. So the simple thing is that if you've got $1 million and your house is paid off and you leave that $1 million in the bank, today the bank will probably pay you 2%. Rates have gone up. Maybe if you're lucky, you might get 2.5%. If you get 2.5% for your $1 million in the bank and your house is paid off, you can't live off that. 2.5% on $1 million is $25,000 a year. I don't think any of you can live off that. So the way to generate wealth, and I am more than happy to sit down with any of you listening to me today, and I don't charge for that, is how you can use your equity, how you can use your combined salaries to actually accumulate wealth through property. So I urge you all to look at this project because it is at the low end of the price entry point, which is why we are showcasing Adelaide, which is why we are showcasing this project. I am not going to sell you a duplex in Brisbane at the moment because the prices have gone absolutely ridiculous. They are asking $950 to $1.05 million for a duplex in most suburbs in Brisbane now. Those that we were selling for around $750 before. And even dual keys are at ridiculous prices. So this presents good value in a growing city with a lot happening there. And I will leave you now for questions. You can, if you wanted to contact any of us, there are our email addresses and phone numbers, but that is on our website as well as Nivas Real Estate. I will now stop sharing and take some questions. Please feel free to ask anything you would like.
Yeah, it's Chris here from Nivas. Please feel free to put in the chat or just speak up. More than happy to answer any questions.